Marie Owens Thomsen is IATA's chief economist, and she joins me now from Geneva. Wonderful to have you, Marie. So help me understand, is this just all increased bookings, or is this cost control? What's really leading or factoring into the profitability forecasts?
I think obviously both are very important contributors to this outcome, and traffic still has room to grow. We do not forecast traffic to return to the 2019 level until 2024, so there should be better results beyond this year and next to be expected.
With profits razor thin, as your report points out, what's the biggest risk to the downside moving forward?
Well, they obviously multiply, given indeed, as you say, this very narrow margin that we are anticipating. That margin actually in divided by the number of passengers that we think will be flying amounts to actually $1 of profit for airlines per passenger. So certainly, I'm in Geneva. You can only buy like a quarter cup of coffee for that kind of money. So that certainly illustrates the vulnerability, and that means that the situation could change from many sources. Our largest cost items, of course, in aviation are the energy costs and also the labor costs. But with such slim margins, every item becomes important. Payment costs, insurance costs, many of these smaller share cost items could indeed upend our forecast.
I wonder what is the most volatile, however, of those factors. Is it oil? I mean, we just talked about yesterday the EU oil price cap and the risk of that perhaps upending the oil market next year. Is it labor? I mean, what is more volatile, do you think, according to your projections?
Well, clearly the oil price is by its inherent nature very volatile. It's a market that responds with great impact to very small variations in supply and demand. So indeed, we would expect multiple spikes in the oil price next year, perhaps notably in February, when there will be an embargo on Russian energy exports in Europe. Other reasons too can cause this volatility. But I must say also that airlines are used to dealing with high energy prices and have been profitable, more profitable than what we are forecasting now, previously with similarly high oil prices, notably between 2011 and 2019. So it's not doesn't necessarily mean that we cannot deliver a profit. The interesting thing is, of course, that we have an unusually high spread between the jet fuel that airlines use and the crude oil prices. So that's an additional handicap for airlines at this junction, that this spread represents a third of the oil price that airlines pay.
Speaking of labor costs, how concerning is it? Just yesterday, I think it was, we learned that Delta Airlines and the pilots reached a deal to pay pilots more than 30% over a 4-year period. Clearly, I mean, there are plenty of stories when it comes to the pilot shortage, the backlog of necessary pilots. I mean, do you think that the news that we got from Delta could set a precedent in terms of other airlines, and that airlines will have to accommodate higher wages for pilots?
Yes, I think this is a particular issue for the US. We do see signs of it elsewhere as well, but not to the same extent. And of course, it's also a global issue, because we now have arguably one of the tightest global labor markets that we have seen and that I can recall. So we're sort of near full employment in the global economy in a way that which is very unusual. So it shifts, of course, some bargaining power into, of course, the hands of labor. And for the global economy, this is a good thing, because the fact that people have jobs is more positive for the global economy and for our industry than the negative impact of inflation on the purchasing power on those wages that people are earning. So it has to be a net positive that people are working.
Mm. I wonder, we talked about strong bookings. I wonder, when does the industry expect bookings to start to normalize? We talk a lot about the pent up demand of travel because of the pandemic, and I understand that it's geographic, right? I mean, you could argue that in certain Asian markets, they haven't started to see that pent up demand come back because of COVID lockdowns. But when does the industry expect the pent up demand of travel to normalize in the larger North American markets, for example?
Yes, I think for sure that this phenomenon exists, yeah, and that people, have been curtailed in their various activities, be it business or leisure, for a number of years, and now there's a need to catch up, and certainly for business travelers to develop new markets and so on. So that catch up phenomenon, I think, might have some more legs, but. The unusual thing that we have also observed is a very seemingly low price sensitivity of this demand. Yeah, so people are prepared to pay the price, and we haven't really seen any dampening effect stemming from the higher ticket prices, which are of course related to the higher oil prices. But this price sensitivity can be expected to come back progressively into the market again. And I would put that around the labor market again, that as long as we have these phenomenal job creation numbers and these low unemployment rates, people can get away with not being very price sensitive. But when that trend changes, I would assume that a greater price sensitivity in our demand for air transport is going to return, probably somewhere towards during the second half of next year could be the time when those things start to shift.
That's an interesting forecast because that's also when some of the forecasts in the U.S. Expect the U.S. unemployment rate to start going up. So it's an interesting parallel there. Marie Owens Thomsen, good to have you. Thank you.